Everyone, from the mainstream media to the gurus on Wall Street, wants you to believe that AI is a bubble. You've seen the headlines. There are thousands of them. You've heard the whispers on every financial news show. This is just like the dot-com crash. They point to the skyrocketing stock prices, the frenzy, the hype, and they tell you to be very, very afraid that this whole thing is just a house of cards ready to come tumbling down. But what if I told you that's exactly what they want you to think? What if all this deafening noise about a bubble is just a massive distraction, a grand misdirection from where the real money, trillions of dollars, is actually going? The truth is, there's a giant black hole forming in the center of our economy, and capital is flooding into it, rewiring the very foundation of our world in a way we've never seen before. This isn't a bubble. It's a fundamental reconstruction of society financed by the most powerful companies in history, and the people fueling it are hiding in plain sight. The story isn't about if AI will crash. It's about what you're missing while you're busy waiting for a crash that isn't coming. At least, not in the way you expect.
Look, before we get to what's really going on, we have to understand the official story. The AI is a bubble argument is so seductive because it's simple, and it plays on a trauma many of us still remember, the dot-com bust of 2000. Here's the story they're selling you. In the late 90s, the world fell head over heels for a new technology, the internet. Speculators poured money into any company with a .com tacked on the end, whether they had profits, revenue, or even a coherent plan. Valuations made 0 sense. Companies like Pets.com, which burned through hundreds of millions before collapsing in a spectacular fireball, became the poster child for this irrational exuberance. When the music finally stopped, the Nasdaq lost almost 80% of its value, and trillions in paper wealth just vanished. Today, the bubble watchers claim they see the exact same patterns. They see NVIDIA, the company making the chips that power AI, hitting a market cap of over $5 trillion, a value greater than the entire economy of most countries. They see startups with no revenue becoming billion-dollar unicorns overnight. They see a mad dash for cash, with investors terrified of missing out. In November of 2025 alone, something like 12,000 articles were published talking about an AI bubble, which was about the same as the previous 10 months combined. The fear is real. It's the #1 tail risk that has investors spooked. They'll point to something they call circular financing, where a giant like Microsoft invests billions into a startup like OpenAI, and OpenAI then uses that money to buy cloud services from, you guessed it, Microsoft. To the bubble theorists, this is just a shell game, money moving from one pocket to another to create the illusion of demand and pump up valuations. It looks artificial. It looks fragile. It looks like a bubble. And you know what? If you only look at the surface, they're not totally wrong. There are pockets of pure absurdity. There are companies that are nothing but hot air. But focusing on them is like staring at a single dead tree and missing the fact that the entire forest around it is growing at a mind-bending speed. The bubble narrative is a simple story for a deeply complex reality, and it conveniently leaves out 3 key pieces of evidence that change the entire picture.
Section 2. The Investigation. Exhibit A. The first and most critical mistake the bubble screamers make is confusing the AI boom with the dot-com bust on a fundamental level. Infrastructure. Back in the dot-com craze, companies raised billions to lay a ridiculous amount of fiber optic cable underground. The idea was that internet use would explode and we'd need all that bandwidth. The problem was, they laid so much of it that a huge portion was never even lit or used. This dark fiber became the perfect symbol of the bubble. Billions of dollars literally buried in the ground based on pure speculation, with no actual demand to justify it. When the crash came, that infrastructure just sat there, empty and useless. The bubble story today assumes the same thing is happening. They see hundreds of billions being poured into data centers and AI chips and think, aha, it's just more dark fiber. a speculative gamble on a future that might not show up. But here's the evidence they're ignoring. The demand isn't speculative. It's real, it's immediate, and it's completely overwhelming. Unlike the dot-com era, the AI infrastructure being built today is getting used the second it comes online. Data center vacancy rates have crashed to historic lows. In 2025, the pipeline for new data centers was already 73% pre-leased. That means companies were signing multi-year contracts for space in buildings that hadn't even been built yet. That's the exact opposite of dark fiber. It's a desperate scramble for capacity. Microsoft's own CFO, Amy Hood, said it plainly in late 2025. "We've been short now for many quarters. I thought we were going to catch up. We are not. Demand is increasing." Mark Zuckerberg said Meta was in a compute-starved state, desperate for more power in the AI arms race. This isn't just talk. The capital expenditure, or CapEx, of the big tech companies tells the real story. In 2025, they were on track to spend over $400 billion on AI. For 2026, those numbers are expected to be notably larger. Wall Street analysts have consistently underestimated this spending. At the start of both 2024 and 2025, they predicted CapEx would grow around 20%. The reality? It shot past 50% in both years. The demand for NVIDIA's GPUs, the engines of AI, is still way ahead of supply. This has even started to cause shortages and price hikes for the memory chips used in those GPUs, which is now hitting the consumer market for gaming cards. When supply is tight, it goes to the highest bidder. And right now, the highest bidders are the data centers. They're buying every chip they can find. So, mistake number one is failing to see this isn't a build it and they will come situation. This is a they are already here and we can't build it fast enough crisis. The demand isn't a forecast, it's a reality, and it's hammering on the door. Section 3. The Investigation. Exhibit B. Follow the money. Okay, on to Exhibit B, the source of the money. A classic bubble, like the 2008 housing crisis or the dot-com bust, is fueled by two things: widespread public hype and tons of debt taken on by weak players. You have everyday people throwing their life savings into the market and shaky companies borrowing fortunes just to get a piece of the action. That is not what is happening here. The AI infrastructure boom isn't being funded by your uncle buying stocks on a tip or by flimsy startups taking out risky loans. It's being bankrolled directly from the massive cash flows of the most profitable companies in human history: Microsoft, Google, Amazon, and Meta. In 2025, these giants spent an estimated $415 billion on CapEx. That sounds like a lot, but it was a manageable slice of their combined revenue of roughly $1.7 trillion. Blackstone even notes that this is a primarily self-funded CapEx cycle, a massive difference from the debt-fueled parties of the past. These companies are so drowning in cash from their main businesses, cloud, ads, e-commerce, that they can afford to pour tens of billions every quarter into building AI's future without even breaking a sweat. Think about what that means. This isn't some fragile ecosystem built on hope and leverage. It's a strategic, long-term project run by the world's most powerful corporations using their own money. They aren't speculating, they are investing. They're building a captive infrastructure where they themselves are the number one customer. And when they do look for outside money, a new powerful player has stepped in: private credit. This isn't your average bank loan. These private credit funds, now managing over $2.2 trillion in assets, are lending money directly to AI-related companies, over $40 billion in 2025 alone. The Bank for International Settlements thinks outstanding private credit to AI firms could hit $500 billion by 2030. This does two things. First, it keeps a lot of the financing off the public markets, making it harder for old-school bubble watches to even see what's happening. Second, because these are often long-term loans locked in for years, it creates a much more stable, patient capital base than the fickle stock market. This brings us back to that circular investment idea. While critics see it as a shell game, it might just be one of the most ruthless and brilliant business strategies ever. Microsoft invests in an AI startup which guarantees that startup uses its Azure cloud platform. This locks in future revenue from Microsoft's cloud business, justifies its insane data center spending, and actively boxes out competitors like Amazon and Google. It's a self-perpetuating, self-funded ecosystem. It's not a bubble waiting for a pinprick from public opinion. It's a fortress being built and paid for by kings using their own treasuries. Individual AI apps might be overvalued and fail, sure, but the patrons funding the whole system are unbelievably profitable and stable.
And that brings us to Exhibit C, the ultimate reality check. The one thing that tethers this whole thing to the real world, the element that acts as an anchor against the pull of speculative fantasy. The true bottleneck of the AI revolution isn't money or hype or lines of code. It's electricity. It is raw, physical power. In a purely speculative bubble, think tulips in the 1600s or dot-com stocks in the 90s, the only real limit is human greed. The sky's the limit because you're just trading paper, promises, and fantasies. But in the real world, big projects have physical constraints. And for AI, the biggest limit, the one nobody can cheat, is the staggering, almost incomprehensible amount of power needed to run everything. This isn't a line on a chart, it's a hard limit imposed by physics. Let's talk numbers, but let's make them real. The International Energy Agency projects that by 2026, that's just around the corner, electricity consumption from data centers, AI, and crypto will more than double, hitting over 1,000 terawatt hours. Now, 1,000 terawatt hours is a number so large it's meaningless, so let's put it this way. That is roughly the same amount of electricity that powers the entire nation of Japan. Think about that. Every factory, every bullet train in Tokyo, every skyscraper in Tokyo, every home, every streetlight in a nation of 125 million people, all of that energy consumption duplicated just to power the world's data centers. Goldman Sachs sees it even more starkly, projecting a 165% surge in data center power use by 2030. Today, AI accounts for maybe 14% of that power usage. By 2027, it's expected to be over a quarter, and that share is growing exponentially. The scale of this demand becomes even clearer when you look at a single action. A simple Google search, an action we perform billions of times a day, uses a tiny amount of power, but a single query on an advanced model like ChatGPT uses nearly 10 times more electricity. Now multiply that by the trillions of interactions that will define the AI-powered future. The math becomes terrifying. The newest AI data centers, the ones being planned right now, aren't just buildings with servers anymore. They're industrial-scale power consumers. Each one requires anywhere from 100 to over 500 megawatts of dedicated power. That's enough to run a small city. We are literally building new cities' worth of power demand dedicated solely to computation.
This insane hunger for energy is creating a crisis for the world's power grids, particularly in the United States. America's electrical grid, a patchwork marvel of 20th century engineering, is in many places 40, 50, even 60 years old. It was never designed for this kind of concentrated, massive demand. It was built for a world of predictable, distributed loads, not for a single building that drinks as much power as a steel mill. The grid operator for 13 states has already issued a stark warning, stating that the unprecedented surge in data centers is creating a serious near-term risk of rolling blackouts. We are retiring old power plants, often fueled by coal and gas, faster than we are building new ones. The math simply doesn't add up. This is the great anchor to reality. The challenge of building a new AI data center is no longer just about concrete and fiber optics. It is a multi-year knockdown, drag-out battle with utility companies just to secure a power allocation. Companies are signing contracts for power that won't be available for 5 years. Building new high-voltage transmission lines, the arteries of the grid, can take a decade or more just to get through the permitting and regulatory process, let alone construction. There are physical shortages of critical grid components. The wait time for a large, high-voltage transformer, without which you cannot connect a data center to the grid, is now measured in years. There is a massive and growing shortage of the skilled electricians and engineers needed to build and maintain this new energy infrastructure. This changes everything. You cannot hype a power plant into existence. You cannot speculate your way around a strained electrical grid. You cannot write clever code to magically create a transformer. The fact that the biggest limit to AI's growth isn't a lack of money, but a desperate existential fight for a physical resource like electricity is the single most compelling argument that this is not some flimsy digital bubble. It proves that the AI boom is welded to the hard, expensive, and slow-moving reality of the physical world. The hundreds of billions of dollars aren't vanishing into thin air. They're being poured into concrete, into steel, into mountains of copper wire, and into power plants. So let's hit pause for a second. We've seen that the infrastructure demand is real, immediate, and overwhelming. We've seen that it's being funded not by debt and public mania, but by the colossal cash flows of the strongest companies on Earth. And now we see that its primary bottleneck is not investor sentiment, but the physical constraints of our energy grid. This is a totally different animal than the dot-com bubble.
So if it's not a bubble, what the hell is it? And more importantly, why does almost everyone want you to believe it is one? What we're all witnessing isn't a speculative stock market event. It is a state change for the global economy. It is a foundational infrastructure project on par with the rollout of the electrical grid in the 20th century or the creation of the interstate highway system. As the investment firm UBS aptly put it, AI isn't a tech sector anymore. It's becoming economic infrastructure. But this time it's different, and profoundly so. Those previous revolutions were largely led by or in partnership with national governments. This time, it's being run almost exclusively by a tiny handful of trillion-dollar corporations that are literally building the next version of the economy in their own image. This isn't a bubble, it's a privately funded industrial revolution. So, why the constant breathless bubble talk? Why the endless headlines and fearful whispers? First, and most simply, it's a lazy narrative that gets clicks. The dot-com crash is a story everyone knows. It's a pre-packaged drama of hubris, greed, and collapse. Comparing the AI boom to it is a simple, brutally effective way for the media to generate fear and grab your eyeballs. Fear is a primal human emotion, and it drives engagement better than anything else. Nuance doesn't sell advertising space. Panic does. It's an easy story to tell, even if it's the wrong one. Second, most financial analysts are simply analyzing the wrong thing. They are trained to watch the froth, the volatile day-to-day stock prices of a few flashy, high-profile companies. They see a new AI application get $1 billion valuation and they scream, bubble. But they are missing the tide. They see the daily stock chart, but they are blind to the multi-year $100 billion capex plans being executed by the giants. They don't have a clear window into the murky, opaque world of private credit, where tens of billions in patient, long-term capital are being deployed to build the physical backbone of this revolution, far from the hysteria of the public markets. They are watching the leaves of a few trees while ignoring the tectonic plates shifting beneath the entire forest. Third, and this is the most cynical and important reason, the bubble narrative actively serves powerful interests. For the market bears and professional pessimists who have been calling for a market crash for years, screaming bubble is how they try to will their prediction into being. For some very smart, very large investors, stoking public fear is a strategic weapon. It can drive prices down, shake out weaker hands, and allow them to buy into this revolution at a cheaper price. And for the vast old guard industries that are facing existential disruption, from traditional manufacturing to legacy media, pretending that AI is just an unstable, speculative fad is a form of corporate wishful thinking. It's a psychological defense mechanism against the terrifying reality that their world is about to be irrevocably changed. As one analyst put it, the market really wants to push the narrative that there is a bubble.
That narrative is a smokescreen. It's a grand and convenient distraction from a much more difficult and uncomfortable truth. We are witnessing the single greatest concentration of power, both computational and economic, into the hands of a few megacorporations in human history. They aren't just building products anymore. They are building the very ground the future will be built on. They are creating the new reality, and they are making the rules. So let's be crystal clear. Will some AI companies fail? Absolutely. Will there be spectacular flameouts? Without a doubt. The market is littered with unprofitable, hype-driven startups that will and should go to zero. That isn't a bubble popping. That is just capitalism, red in tooth and claw, doing its job. It's the market's immune system clearing out the weak and the foolish. The collapse of pets.com in 2000 didn't mean the internet was a fad, and the inevitable failure of some gimmicky AI chatbot in 2026 won't mean the AI revolution is over. Those are just sideshows, distractions from the main event. The main event is the infrastructure, the data centers, the silicon foundries, the power grids. That is not going away. You don't just tear down a gigawatt data center campus because a few software apps fail. The trillions of dollars being spent are creating real, tangible, long-lived assets that will form the bedrock of the global economy for decades to come. The entire conversation is already shifting. It's moving from, is this thing alive, to how do we regulate it? It's shifting from, will this technology take my job, to how do I use this technology to make my job better? That is not the sound of a bubble popping. That is the sound of a technology weaving itself into the permanent fabric of our lives. The people screaming AI bubble are looking in the rearview mirror, trying to fight the last war. They are haunted by the ghosts of the year 2000, and that memory is blinding them to the completely different reality happening right under their feet in 2026. The real risk isn't getting caught in a speculative bubble that pops. That's a 20th century fear for a 21st century transformation. The real risk is sitting on the sidelines, paralyzed by a manufactured fear, waiting for a crash that never hits the core of the industry, while the entire economic landscape reshapes itself without you. The game isn't just about software anymore. It's about silicon, steel, and power. And the foundations of that new world are being poured right now in